He started in a corner of a car lot, scrubbing hubcaps and folding sun-faded brochures. But the man who would quietly reshape the way millions of Americans buy cars didn't build an empire by polishing chrome alone. He built it by finding customers other lenders said were too risky, by inventing financing to fit their lives, and by turning a stubborn streak for numbers into a machine that moved cars, cash, and headlines. This is the story of Don Hankey, the under-the-radar billionaire who made his name in subprime car loans, then quietly diversified into insurance, real estate, and in one jaw-dropping moment, backed one of the most talked-about legal gambles of the decade. Don Hankey was born into the family business, the kind of childhood that smells like motor oil and coffee. He grew up in Los Angeles, learned the rhythms of a dealership from the ground up, and absorbed an early lesson that would shape his whole career. When the rest of the market says no, there's value in saying yes, if you know how to manage the risk. He studied at the University of Southern California, but it was the family Ford franchise that became his classroom. By 1972, he had taken control of Midway Ford, not as a flashy takeover, but as an operational handover from one generation to the next. That was his first move as a businessman who thought in long arcs. From a single dealership came a simple idea. Cars shouldn't be a luxury reserved for perfect credit scores. For millions, a car is a lifeline, an entry ticket to work, childcare, and emergency help. Lenders who looked only at neat spreadsheets and spotless credit reports were leaving whole neighborhoods stranded. Hankey saw a market that others scorned and decided to serve it. In 1978, he founded Westlake Financial. It started small, as many good businesses do, a solution to a problem he saw on his lot. But Westlake wasn't charity, it was engineering, taking imperfect credit data, calculating realistic risk, and designing loans that would keep payments moving even when life got messy. That combination of human intuition and number crunching produced two things Hankey loved: volume and margin. Word spread fast among buyers who'd been shut out. Dealerships that needed a financing partner began to prefer Westlake. What had been an awkward, inconvenient niche became a profitable specialty. But profit alone didn't make Hankey interesting. What did was his appetite for systems. He didn't merely hand out loans, he built an operating machine. Westlake used data, models, and, eventually, automated systems to scale underwriting decisions. When other lenders balked at the thin margins of high-risk borrowers, Westlake perfected the calculus: take more customers, price accordingly, and manage collections aggressively. Critics would later call those methods ruthless. Supporters would say they provided an honest, if expensive way for people with damaged credit to access transportation. Expansion arrived in two forms: vertical and horizontal. Vertically, Hankey made sure Westlake could be the one-stop solution for dealers. Financing, insurance, and even rental cars tied back to the group's dealerships. Horizontally, he diversified. The Hankey Group grew into a constellation of businesses: Midway Auto Group, Westlake Financial, Knight Specialty Insurance, Hankey Investment, and more. These companies were less a random conglomerate and more a tightly woven web, each business feeding another, pooling risk and reward. With his empire humming, Hankey made real estate and insurance the future hedges for a company rooted in car loans. The logic is simple: loans can default during recessions. Bricks and contracts often retain different kinds of value. Hankey invested in properties in Los Angeles and built a private insurance arm that could underwrite larger risks, the sort of thing that most banks or public companies would think twice about. He liked to say the moves were practical and businesslike, not theatrical. That modesty would collide with national attention years later. For decades, he cultivated a reputation for low publicity. Unlike many billionaires who sign up for interviews and spreads, Hankey kept a tight circle. You could find his name in filings, in local business journals, on the signage of car lots, but not in gossip columns. That changed dramatically in the spring of 2024, when Hankey stepped into a story that had nothing to do with car loans and everything to do with high-stakes legal drama. When a New York judge ordered a former president to pay an enormous civil penalty, the legal machinery moved fast, and with it, the need for a massive bond to appeal. The man in question needed a company willing to underwrite a $175 million appeal bond. Many insurers balked. Enter Hankey's Knight Specialty Insurance. Quietly, decisively, Hankey's company underwrote the bond. It was an act that leapt from the balance sheet into the headlines. A billionaire who had made his name in financing loans for the overlooked was now underwriting one of the most politically charged legal maneuvers in modern memory. For Hankey, it was, by his own account, a business decision, not a political statement. For the world, it was proof that this private man's calculations could have public consequences. That moment crystallized public fascination. Here was a guy who preferred numbers to noise, suddenly at the center of controversy. Reporters dug into his empire. They found that while Westlake's reach had transformed car financing for millions, regulators had also scrutinized some of its practices. In 2015, the consumer watchdog found infractions in the way debt collectors were operating under companies in Hankey's orbit, tactics that crossed legal lines in the eyes of regulators. The firms were ordered to provide millions in relief and change practices. It was a stark reminder that scaling a high-risk business carries real social responsibility. For Hankey, it was also a moment to defend an approach he called pragmatic. If people were denied cars, they could lose jobs, and that too would ripple through communities. Hankey's critics paint him as emblematic of the subprime era's moral gray zones. His defenders, including many dealers and borrowers, argue that his companies did something few others would. They lent to people who needed credit, not merely those who were already wealthy or judged safe. There's truth on both sides. What makes his story cinematic isn't a clean hero or villain arc, it's complexity. He built bridges where the system left gaps, and in doing so, he put himself at the intersection of profit, policy, and people's everyday lives. As his fortune swelled, Hankey moved quietly into high-end real estate and boutique investments. He financed trophy homes and major developments in Los Angeles, sometimes with bold bets that raised eyebrows. He lent to ambitious builders and took stakes in projects that had the potential for huge payoff and huge risk. Those moves weren't vanity. They were part of a long-term hedging strategy, convert financial capital from one sector into lasting assets in another. For someone who watches numbers like a hawk, real estate's tangible returns offered a comfortable complement to loans' unpredictable yields. If there's a lesson beneath the ledger lines, it's this. Don Hankey built a business on an old-fashioned sales principle: serve a market others won't touch, and then paired it with modern risk controls. He wasn't an ideologue, he was an optimizer. That makes him a polarizing figure in an economic moment where questions about fairness and access are everywhere. Should people with bad credit be able to get loans at high interest? If a lender says yes, how far can they go to collect when payments falter? Hankey answered those questions practically, by building systems, by hiring people to manage collections, and by using courts and contracts to protect his capital. The result, a business that fed itself and expanded into other domains. But let's not mistake the man for a machine. Those who know him describe a private family life and a habit of low-key philanthropy. He and his wife launched a foundation. He donated in ways that rarely sought public applause. Even his biggest gambles, like stepping forward to underwrite that massive bond, came with a posture of detachment. A deal done, numbers crunched, risk assessed. The headlines came later. And what about legacy? For every critic who points to harsh collection practices, there's an employee whose paycheck came from a job Hankey's companies created, a dealer who sold cars to buyers who otherwise would have walked away, a borrower who kept a job because a car payment was structured to fit a life that didn't fit neat credit categories. Legacies are messy, and Hankey's is emblematic of American capitalism's contradictions. Ingenuity and controversy stitched together. In the last decades, Hankey's name migrated from local business directories to the global lists of the super rich. Forbes, Bloomberg, and other financial outlets have tracked his net worth as his holdings expanded. Hankey remains secretive about many numbers, but there's no denying scale. Westlake alone touches tens of thousands of dealership relationships and has billions in loan portfolios. The Hankey Group's tentacles reach beyond the lot, into insurance, real estate, and financial services, a deliberate diversification strategy that would make any prudent investor nod in approval. So how did a kid who learned the business on a car lot become one of the wealthiest people in Los Angeles? By combining an old-school eye for customers with a relentless focus on the math behind lending. By building companies that complemented each other, and by positioning himself to make big moves when capital opportunities presented themselves. And by being willing to be unpopular at times, because making unpopular loans to underserved customers is, by definition, a bet against consensus. Don Hankey's story is not a simple rags-to-riches fairy tale, nor is it an easy moral fable. It's a study in modern American financial entrepreneurship. Find a market others ignore, engineer a way to serve it safely, and then use those returns to buy optionality in other sectors. It's a reminder that the levers of capitalism can lift up or bruise, sometimes both at once. As you watch the next car pull out of a lot, consider the invisible wheels that made that sale possible. A lender who specialized in risk, models that priced loans, dealers who closed deals, and the people who needed the car enough to take on a higher cost of credit. Don Hankey built a system for those transactions. Whether you admire him for opening doors or criticize him for the door's price tags, you can't deny he reshaped part of America's financial landscape. And that's the real hook of Hankey's life. It's not just about cars or bonds or mansions. It's about what happens when one person decides that the people other banks refuse to serve are still people worth serving, and then builds an enormous machine to do exactly that. That decision changed tens of thousands of lives, and it made one quiet man in Malibu, for better or worse, impossible to ignore.